From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for June 27th, the last Friday in June. Where did the month go? Well, let's see what's happening this weekend. Let's start with the Brewers as they welcome the Rockies to town. And of course, we have the second of 3 weekends of Summerfest, the world's largest music festival. And to add a little balance to your diet, there's a Cedarburg Strawberry Fest. A man in Connecticut locked himself out of his house, but he also locked his dog inside the house. He had the bright idea of crawling down the chimney, but he got stuck. To recap, the dog's locked in the house, his owner is stuck in his chimney, and like a good neighbor, they called the cops and fire department. And in their effort, they caused $5,000 to $10,000 of damage to the roof and chimney. I wonder what Jacob State Farm would say to this. The Appalachian Trail is over 2,000 miles long from Maine to Georgia, and the halfway mark is Gardner, Pennsylvania. And they have an ice cream shop for the hikers. You can celebrate the halfway point by downing a half of a gallon of ice cream. A recent hiker described the experience as pure misery. Okay, Sparky, come to Wisconsin. We celebrate with a half gallon of custard for every day that ends in Y. Our goofy headline is from the Des Moines, Iowa Register. Loose chicken rescued from Buffalo Wild Wings. Where, the deep fryer? On the podcast today, we have Dave Sandstrom, Art Rothschild, Joel Driesing, and getting us ready for the weekend. Here's Kyle Tetting.
Well, thanks, Max, and maybe a bit of a party as we head into the weekend. The NASDAQ up a massive 4.2% this week. Dow Jones Industrial Average up 3.8%. That's 1,612 points on the week after adding 432 points on Friday. And the S&P finishing back at record levels, up 3.4% for the week, 205 points, closing at 6173 for the year. NASDAQ up 5.3%, the S&P up 5.6%, and the Dow up 3.9%. Art, hard not to start with maybe a bit of enthusiasm about how well the stock market has done. And I think often, despite any real clarity on a lot of the pieces that had caused it to sell off earlier in the year, I know some of your notes ahead of the podcast suggested that maybe there's some optimism from investors that things are going okay, and yet we don't have a lot of clear evidence that that's the case. What do you take away from a week in which the S&P is back at record highs and seeing massive, massive gains on stocks?
Yeah, you would have told me that the United States was going to bomb Iran, oil prices were going to go down, and the stock market was going to go up. I'd really question your sanity, but that's exactly what just happened. The enthusiasm really is a great word. You know, I was using the word confidence. I think the lesson of this entire year is don't confuse politics with economics. Don't confuse your view of the world or the country with what is really happening. And this was such a strong economy, you know, when this president took office, that despite the threat of tariffs, you know, which really have kept the market down for the most part for most of the year and really brought it down and up again in April, this is sort of like a relief rally that we just experienced. And not to mention the bombing thing, you know, I don't think it makes any difference whether, you know, they've got a few, you know, grams or whatever it is of uranium floating around. You know, the fact of the matter is this is a tremendously significant move in an effort to establish peace in the Middle East. And I think investors have accepted that. I think that's part of the equation this week. So it's not whether there's anything in the economy that should tell us that, yeah, we're in the clear at this point. It's that we have overcome, as I suggested, and this has been suggested over time, a bull market climbs a wall of worry. So we still have tariff concerns. We still have U.S. stocks that are very, very expensive. We still have, geopolitical concerns. But here we are with this absolutely spectacular week on Wall Street in a year in which we're now again in record territory. So put on the blinders, have an appropriate, allocation to equities, have enough bonds and cash for safety, and let's just keep our fingers crossed that this will continue, because I couldn't be happier.
Dave, just about the midpoint of the year for investors. We've got a day next week. Obviously, a lot can happen over the weekend and in a day, but I think it's pretty fair to say that balanced portfolios have far, far exceeded the expectations, fairly low expectations, I think, set for balanced investors. You look at any number of headlines over the last few years, kind of calling the 60-40 portfolio dead, and yet, again, here we are 6 months in, and it feels very much like perhaps those headlines might have been written a little bit too soon.
I think a premature death notice went out on that one, Kyle. Obviously, what we've seen this year has really proven the fact that there is lots of safety to be had from balance. Obviously, what we've seen this year is an outstanding performance from the international equities markets. We've seen bonds holding their own. So having a 60-40 portfolio, especially with a reasonable allocation to international stocks, has really put you in a pretty good place. And I think even more importantly was the impact that it had at the depths of the sell-off. When I was reviewing clients' portfolios at the height of the angst following Liberation Day, the S&P 500 down 15% at that point, and a lot of the balanced portfolios we were looking at were down less than half of that. So remarkable resilience during that time. So yeah, definitely not time to give up on balance or the 60-40 model.
I think it's a strong reminder for investors that you get yourself out of a big hole like the decline we saw in April, in part by making sure that you didn't dig the hole so deep to begin with. And I think, the questions around what do we do in response to market decline, well, the bigger the market decline, the more painful you feel it, the harder it is to claw back. And of course, for those investors that had counted on their balance to kind of carry them through that uncertainty, well, odds are it didn't hurt quite as much. You didn't feel the need to react just as much. And so, of course, then on the other side, you can come back a little quicker. You add in that bonds have rallied sharply. You add in that the non-U.S. pieces rallied sharply. And I think, again, it made it much more palatable for investors, and that reminder that, balance does work. It doesn't work when the only thing that's going up is a small number of large cap growth stocks that, quite candidly should be making money, but a reminder that there's other places as well. And then, Art, we got a lot of news, I think, this week on kind of expectations for the bond market. Jay Powell speaking. You have a president that seems now potentially more inclined to name a successor sooner rather than later if the Fed isn't going to take those steps. And at the same time, you had some Fed members maybe coming around to the idea that rate cuts in the near term might make some sense. It feels like maybe the bond market has responded a little favorably to that. Rates down a bit this week. And so in a week in which stocks are up, our bond portfolios are probably up a little bit as well.
Yeah, and all year, as part of that balanced portfolio, bonds have done well. Either intermediate bonds have made maybe a little more than short-term bonds, but even short-term bonds have done very well with virtually no volatility. And cash has done very well, despite the fact that we should expect interest rates to go down. There's controversy about Chairman Powell on the part of the president. I mean, the president he appointed the guy. Tremendous. I think in the 34 years I've been here, I think the guy's done the best job of any chairman of the Federal Reserve that I've seen, and we've seen some good ones. Bernanke was good. Yellen was good. Greenspan, you couldn't understand him, but he knew what he was doing. But this guy is very appropriately being patient and trying to decide the impact of tariffs on the economy and whether it will result in higher inflation. And so far, the jury's out on that. It's remarkable how little we've seen flow through. It still could happen. And so, and this threat of, having a shadow, chairman, so to speak, if the president appoints someone, very early, I don't think it's necessary. The fact that I think the writing's on the wall. The question is whether it's going to be July or September. We're going to see lower short-term rates as long as we don't see a flare-up in inflation. And that's another reason for the rally this week. I think the market's expecting it. Investors love being able to get cheap money that they can pour into something. And it looks like the stock market for the time being is going to be the place. So controversy, it's really a sideshow right now. Powell's going to hopefully continue to do his job. And if the president appoints somebody else, so be it. But the direction's pretty clear. We're going to have we're going to have lower short-term rates. And the controversy, though, really is on the other side. Long-term rates could go higher if they pass a bill that creates bigger budget deficits going forward. So I think we've got to be cautious, as to how far out we go. We always are, on the yield curve. And I still like stocks in here. That's pretty amazing what's happened. Lower interest rates, higher stock prices, and higher corporate profits down the road, despite higher prices in the stock market right now. So it's a good time to be an investor.
I think that's fair. Just briefly on kind of Jay Powell and the Fed, I think there is a bit of a misunderstanding of what the mandate of the Fed truly is, and that the Fed doesn't just say, well, what do we want to happen with interest rates? No, they are congressionally mandated to look at price stability and full employment. And absent some kind of disruption in those two areas, and especially the full employment area, well, you put more emphasis on price stability, which is what the Fed is doing, and leaving rates more restrictive, higher than what the neutral interest rate would be right now. And so I think, Jay Powell's hands are tied not by what he wants or what the Fed more broadly wants, but to your point, what the data is actually saying. The data is saying inflation is still the more relevant point to consider. It's running hotter than we think it should be running, and so we are not in a hurry to cut rates. And so I think that's the important part to remember is this isn't the Fed's choice. This is the Fed doing what they are congressionally mandated to do. Joel, we had some economic data this week, in particular an update on the GDP report, closely watched. Not a lot of new information there.
Right. Yeah. I think one of the challenges for the Fed is, and the reason they're taking this wait and see standpoint on lowering interest rates is they're waiting to see what happens with the tariffs. We keep expecting higher inflation. Economists say that those changes in trade policies are going to cause price increases, and we're not seeing it that much yet. We had the first quarter GDP, gross domestic product report, and the inflation number there was pretty mild, and that's just for the first 3 months. And Independence Day came on the 1st of April, but we had the personal spending, personal consumption numbers that came out today for the month of May. So it's a month after the whole trade policy kerfuffle, and those interest rates, the inflation rate was 2.3%. It's up a little bit from April, but it's still, within spitting distance of the 2% long-term rate that the Fed has. So inflation so far hasn't been that much of a concern in a lot of these numbers. There might be more of a concern for the labor aspect of it, and we're not hearing a lot about that yet. But every week we look at the 4-week moving average for initial claims for unemployment, and those have been a little higher. Last week they were at a 2-year high, which, grand scheme of things, 2 years isn't a lot. They're also 32% below the 58-year average, so that's still pretty mild. But another number in there is the insured unemployment claims, and those are so 96% of the workers in the country are covered by unemployment insurance. So of them, the ones who are claiming unemployment, it's the highest it's been since 2021. So closer to when the pandemic recession was occurring. So that's just something to watch. Overall, the labor market's still pretty healthy, but those might be some things that the Fed are looking at when they're gauging when to lower rates.
And we talk a lot about consumer confidence, consumer sentiment. We got both readings this week, which is always fun to kind of see what kind of discrepancy there is. measuring slightly different things in slightly different ways. And so a lot of nuance in the conversation there, but both of them kind of telling a story of things that aren't great, but maybe in one area at least look a little better than they did.
And here's where we talk about how more than 2/3 of the GDP is driven by consumer spending.
Mark that one off the bingo card.
Thank you. And consumer confidence, consumer sentiment are believed to affect consumer spending down the road. And both of those have been weak lately because of the tariffs, because consumers are expecting that the economy is going to slow, and because consumers are expecting that inflation is going to come back as it had been a couple years ago. But again, they're not seeing it that much yet, and they're seeing back-offs on the trade policies on how severe the tariffs are going to be, or kicking the can down the road to say, well, we'll figure this out later. So there's been lower expectations by consumers for the effects of these tariffs, but that's still out there.
And then the other big thing that tends to impact spending is household formation in our country. You have new households, you have more home shopping going on. And so looking at things like existing home sales and new home sales and seeing kind of a slowdown there, especially recently, maybe some signs that some of those bigger ticket purchases aren't going to happen the way that we thought. But in particular, I look at the new home sales number down 13.7% in May. Well, that's 13.7% fewer or less homes being sold, new homes being sold than maybe what was a more reasonable pace.
Right, and if we had more of those new homes, then we would have more of the existing homes selling it, because it's a whole supply and demand thing. And the overall home sales, the biggest part of that are the existing home sales, and they're around 30-year lows. We haven't been selling many houses lately. The Realtors Association, which puts a lot of these numbers together, they've been blaming supply, but more lately they've been blaming mortgage rates. Just the price of owning a house is so much higher than it used to be.
We're starting to see some weakness on both coasts now, too, Joel. I mean, there are pockets of the country that prices are starting to decline, and the sales are starting to stagnate. I know that out in the Southwest, Arizona's having some issues. Florida's starting to have some issues. Still very robust in the Midwest. Wisconsin is especially strong, and you're still seeing those houses selling on the first day they're put on the market with multiple offers. But there are segments of the country that are starting to show some weakness in that. So it'll be interesting to see if that's the start of something a little larger.
Yeah, Dave, the Case-Shiller home price index looks on a year-to-year basis, and they've seen a deceleration in the year-to-year gap between so they're seeing price increases lowering month to month, and they've been seeing that.
But that's
for
good news for inflation.
Yes, it is, because housing has an oversized role in inflation numbers.
And that's the reason I bring that up, Art, is that's been the one component of this inflation battle, I think, that has really frustrated the Federal Reserve. That's the one thing that they haven't been able to budge.
And it's hard to control, because you can't build a lot of houses real fast.
Well, and arguably higher interest rates, which generally help the inflation conversation by trying to restrict demand a little bit. Well, higher interest rates hurt the housing conversation, because all of a sudden that translates to higher mortgage rates. And so I think, one of the things that kind of froze up the market for a little bit was those higher rates keeping people from, moving as freely as they otherwise would.
I saw an interesting number in the Wall Street Journal this week. They talked about families that earned $100,000 or more. And in 2019, earning that much, you'd be able to afford 65% of the houses for sale. Now it's 37%.
So that can be solved easily, though. All you need is a Fed policy or for example, quantitative easing that would bring long-term interest rates down. So, if it became a significant problem, once inflation's under control, I could see the Fed possibly doing something.
You'd still have to have the houses, though. That's a problem.
That'll drive the prices higher, of course. But right now, if you have reduced demand, you're going to have some lower prices for the time being. Not to mention that the builders can borrow, at lower rates or at higher rates and jack up the prices of the houses and give them a lower interest rate when they buy the home. So, I think this is a temporary thing right now. We'll have to see what happens.
We should certainly hope. Well, with 4th of July on tap next week, hope everyone has a safe weekend, a safe week leading into the holiday week next week, and enjoy doing the program for you. We'll talk to you all next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.